right, everybody, welcome back to HR Heretics. Today we have an awesome guest on the show. We have Peter Walker joining us from Carta. Peter is the head of insights, and they just put out a very interesting report on the state of startup compensation for H2 of 2023. So we're going to get into this thing. Peter, thanks so much for joining us.
Absolutely, Nolan. Yeah, pleasure to be here.
All right, so we're going to get right into it. I keep hearing from VCs that they're sitting on the most dry powder ever. And so I would just love for you to talk to us about where did VC capital go in 2023 and how did that compare historically?
Nolan, what do you mean by dry powder? Not everyone might know.
Let's start there, Nolan.
Yeah. So dry powder is they raised a bunch of money from LPs that is now still sitting generally in like the LP's pocket because the capital hasn't been called by VCs to then go put into companies. That's what dry powder means.
Yep.
Exactly. So as you mentioned, VCs have committed or LPs have committed a lot of money over, the numbers that you hear thrown around are $200 billion plus dollars to the VC asset class. But that money has yet to be called to be put to work investing in startups. So what is this dry powder? What does this really mean for founders and how do we go through? Look, if we just compare the general gist of what happened in 2023, it wasn't a good year. On Carta, the collective Carta companies, which is something like 40,000 startups or so now, in 2021, those companies raised $220 billion. In 2023, they raised 65. So that is a gigantic drop. So VCs are not deploying capital at the same rate that they were in the last 2 years, hands down, for sure. Now, what a lot of founders then say is, well, okay, but they've committed, the LPs have committed this capital, so certainly it's going to get deployed at some point. And the points that I always make are two things. One, that doesn't have to happen on a timeline that's useful to the founder. The VCs can just not deploy it for a long time, much longer than the company can generally stay solvent. And two, and more importantly, a lot of that capital is going to go to different places rather than net new companies. It's going to be spent on bridges and extensions for current portfolio companies. It's going to go into convertible notes and safes, and it's going to go do a work to keep companies that these VCs already invested in alive. And that is a different thing than, hey, we're going to invest into, 6 new Series A companies this year. So a lot of that dry powder is never going to really come into play for a lot of founders.
That's super interesting. So now tell me about the distribution. So what I'm most interested in is early stage, so call it like seed, Series A, growth stages, that B to Z zone, and then late stages, D and beyond. What did it look like in 2023 compared to what you saw historically?
So let's just say 2019 as like the pre-bubble times versus 2023. In 2019, 30% of capital went to seed and Series A. Another, call it 28 to 30% of capital went to Series D and beyond. So that's 30, and then like a little bit more into the mid stage. It was fairly equally split, a third. In 2023, something like 44% of capital went to early stage and only 14 went to late stage. So what does that mean? That means that there are way fewer late stage rounds and many, many fewer $100 million plus rounds happening than there used to be. There's also fewer seed and Series A rounds happening, but they held up relatively better. So the total mix shifted early. But if you're talking about, again, if the number is $250 billion, that amount of capital cannot be invested into early stage startups. There are not enough early stage startups to take that money in. It's an investor who's used to writing $15 million checks is not suddenly just going to start writing $2 million checks for all these seed stage companies. So a lot of that dry powder, again, has to go to late stage, and late stage has not popped back up yet.
Yeah, it also validates what I'm hearing just from my friends in VC, which is there's a lot of alpha in the seed and Series A stage, which basically means like if I put in an early check, it is more likely to fail, but the outcome on it could be massive. Versus now the later stage companies, right now it doesn't appear like they're perceived to have the same amount of alpha. Like if I put in $100 million into a Series D, Like, am I going to, wait, what's my opportunity to get a 10x on that?
Right.
And
So
that's
potentially more early stage investments with the risk of losing some better than one big investment.
Yes, but the problem is there's just, if you're just going to say everyone invests in the early stage, that also isn't really a solution for venture as a whole. Like not everyone can come down to the early stage. And it is why at some early stages, especially here in San Francisco and Silicon Valley broadly, some of these price dynamics are wacky. There's enough competition at the early stage that the valuations are actually pretty high right now. You would think they would have come down a lot. They really didn't, at least for seed rounds and Series A rounds. They're close to as high as they've ever been on a median basis. So a lot of competition at the early stage. And then, of course, the question remains, do companies grow radically differently in this age of AI than they used to? Will they need as much late stage capital? Like there's a lot of uncertain questions for late stage VC in particular.
And question, Peter, I mean,
Yeah.
a lot of these later stage companies, C, D, E, they're kind of stuck
Yeah.
right now. Like they should have been public 2 years ago. Right? They're kind of waiting.
Yeah.
Maybe they're thinking about raising next year, the year after, because of everything in the macro. Do you think they're going to have a harder time raising? How do you see that?
I do. Some of them are putting off raising because they can. Some of them are putting off raising because they're doing everything they can to raise and no one wants to give them more money right now. But if you look at the public markets, multiples on SaaS companies, if you just use that as a proxy for the market as a whole, have come down a huge amount. And we're seeing historically low rates of IPOs. Now, maybe Reddit changes things. That went off really well, it seems like. So that's fantastic. We need some more momentum on the IPO market to really get back to health. But there's late stage companies who are taking bridge rounds, taking down rounds. They're radically changing because everything has radically changed around them. If they grew up in an era of low interest rates, maybe their business model doesn't work as well in the era of high interest rates. It's a major shift. The way that we talk about it at Carta is this is a wonderful time to start a company. It is a pretty difficult time to grow one if you had already started in that old world.
That's really well said. Let's talk about startup deaths. So the unfortunate reality is many startups are shutting down right now. I just want to hear, like, what does the data look like? Like, what are you guys seeing with the Carta data?
It's not pretty, for sure. 2023 was the worst year for startup shutdowns on Carta since we were a company. 2013 is when Carta was started. So worst year. And unfortunately, January 2024 was the worst month. So I'm not sure that it's going to be the case that this slows down in 2024. Now, a lot of people want us to produce what's called like a startup failure rate. What percent of startups went out of business in any quarter or something like that? The difficulty with that is it's really hard to get a stable denominator for that rate because more startups are joining Carta all the time. There's a lot of startups being created, et cetera, et cetera. What I can tell you is 2023 was the worst year for shutdowns for every single cohort year of startups on Carta. So, for instance, if you were founded in 2018, when were you most likely to have shut down? 2023. If you were founded in 2019, 2023. If you were founded in 2020, 2023. It was the worst year for startups of all ages, which tells me that it was just a really difficult year for shutdowns. A lot of companies didn't make it through the change from old world to new world.
That makes me sad. Like I feel sad.
It's super sad. And I don't like, one of the things that you hear when you talk about startup shutdowns and everything is, well, two words come up that I don't love. One is tourist. Like, oh, those were tourist founders or they didn't get into it for the right reasons, which is bullshit. Like, I hate that. And two is this is a return to health and it's a good thing, which I have to say, like, might be true if you're looking at this as a economic
ecosystem
model, but it's not. These are people. These founders were trying to do something great. They were employing people. Like, let's be a little bit more empathetic to how difficult a startup shutdown can be on a bunch of people.
Humans.
Yes, totally.
So then the big question is, if 2023 was the worst year you've ever seen for startup deaths on Carta, what is 2024 going to look like?
My instinct is that it again will be worse than 2023. What I'm hoping is that it won't be that much worse. So the jump from 2022 to 2023 was about 2 times in terms of number of startups shut down. 2023 to 2024, I'm hoping for a reduction in the growth rates is perhaps the best we can hope for. Look, the crux of it is if interest rates changed in early 2022, we are now effectively 2 years on from that period. VCs in many cases probably gave their portfolio companies a little bit more leeway. They were more willing to do a bridge or an extension saying, look, things changed on you. We understand that. Here's a little bit more cash. Like, hopefully you can make it to the next round. My instinct is that sort of behavior won't be as available to people in 2024. They'll look around and say, look, you're just not going to make it. Like, in their mind, throw good money after bad. So it's my gut is that there's going to be fewer extensions, fewer bridges, and more shutdowns this year.
Hey everyone, we'll be right back in a moment after a word from our sponsors.
There's a world where your CRM is powerful, easily configured, and deeply intuitive. Attio makes that a reality. Attio is a radically new CRM built specifically for the new era of companies. It's flexible, easily configures to your unique data structures, works for any go-to-market motion from self-serve to sales-led. Attio automatically enriches your contacts, syncs your emails and calendar, lets you create powerful reports, and quickly build Zapier-style automations. The next era of companies deserves more than a one-size-fits-all CRM with an outdated UX. Join OpenAI, Replicate, 11 Labs, and more. Try Attio instantly at attio.com. That's ATTIO.com, and tell them Nolan and Kelli from HR Heretics sent you. So shutdown is one of the potential outcomes. The other potential outcome is merger acquisition.
Yep.
What does the data look like for M&A? Because the story that founders, I think, want to tell themselves is like, oh, well, we won't be able to raise, so like the next thing we're going to do is sell the company.
Right.
And I keep hearing anecdotally the M&A market is not what people think it is.
Our data backs up the anecdote. So it's not impossible, right? There are companies that are being bought every day, every quarter. It's probably about 150 companies a quarter are purchased that are acquired, I should say, that are Carta companies. The problem is that's basically flat from where it was in 2022. And I don't see, maybe there'll be an M&A boom this year. It's possible. The other point to make to founders who are thinking that is that you can't pivot from one thing to another without having laid some ground. So if you're looking for a fundraising round and don't raise it and you only have 3 months left in this company's life before you run out of money, it's incredibly unlikely that you'll be able to.
You have no leverage.
One, you have no leverage, and two, you haven't started the conversations yet. These things don't happen in a period of weeks.
Yeah, and I mean, companies, right? They get bought, not sold. I mean, It's kind of my double click on that, Peter. That was my question: is M&A? My double click underneath that is private equity. Any data or point of view on that piece of the pie?
PE is definitely one of the bigger buyers of startups. PE, other startups, big tech probably encompass most of the purchases of these companies. PE has been, again, it's not the roaring 20s. Like they're not purchases happening all the time, but it's kind of a steady looking at things. There are roll-ups happening, et cetera. Unfortunately, I think a lot of companies are going to try to sell themselves and are going to be disappointed. That's my instinct about this coming year. Maybe more startups get acquired, yes, but the other thing is, unfortunately, we don't have the ability to tell whether or not an acquisition was quote unquote quality. So we don't know if that was, hey, you're just going to basically acqui-hire some people and nobody's going to make a lot of money, or if it was a real significant exit for a lot of people on the cap table. We really can't see that. So my gut is a lot of acquisitions that are happening are also just acqui-hires, or they're not actually meaningfully impacting the wealth of the people that were in the company beforehand.
Yeah, it's so interesting because that ends up hurting the venture ecosystem, right?
Yes.
Like if you're putting capital into the venture ecosystem and you're losing money as an investor, I think you're just less likely to do that in the future. The other piece is startup hiring in the United States is a huge driver of employment in our country.
Yep.
And so there was some really interesting data as I was going through the Carta report around employment in startups. Can you tell us what that data looks like?
Absolutely. So again, when we talk about, call it a universe of on the order of 40 to 45,000 startups on Carta, and you say, okay, if we just look collectively across those startups, how many people do they hire every year? In 2019, fewer startups on Carta, but they hired about 280,000 people, and about 125,000 people left, either through layoff or left by choice, whatever. They departed the company. So that's a good ratio, right? In 2021 and 2022, startups on Carta hired 500,000 people, basically 520,000 each year. So wild growth. Startups were booming, headcount was growing across all these places. Good times. 2022 to 2023, it goes from 523,000 hires to 260,000 hires, cut in half. So that was the hiring market last year. And then if you pair that with the departures market, it was more people left startups on Carta than joined them in 2023. So the industry, the whole asset class, got smaller in terms of headcount last year. That's the first time that's happened ever in our data. We didn't have a ton of data on hiring and something back in 2013, but in the last 5-6 years, that's the first time that's happened.
Ever. Yeah.
And a lot of those,
Damn.
as we've seen from the headlines, a lot of those departures were layoffs, not departures by choice.
So, 2024, there is some rumblings that people are hiring again.
Mm-hmm.
Do you have any early data on 2024?
Not a ton of it, candidly. I think January is gonna be a decent month for hiring. The long and short of it is layoffs are down from where they were peaking in early 23, but they're not gone. They haven't subsided completely, and it's my instinct here is that a lot of startups really took the shift and the advice, candidly, from VCs to scrutinize headcount very closely, be incredibly capital efficient when it comes to your growth. They've taken that to heart. And so I would be reluctant to bet on a huge hiring uptick this year. I think it'll be better than 2023, but maybe not meaningfully better.
Yeah, and that scrutiny, I mean, it was more like a mandate
Yeah.
than like a suggestion. And I guess my question underneath that data, Peter, is I know it's all tech, but is there any trends that you're seeing in your data on type of industry, geolocation, anything like that, right? AI, security tend to be more healthy than others. Anything you can offer on that front?
Yeah, I think the AI story holds up pretty well here. AI companies raised at higher rates for higher valuations and probably hired a few more people than other sectors. When we did this, there's a heat map in the report where we looked at the various industries and whether or not they were growing. So we did a ratio of new hires to departing people. So if it's at 1, you're just flat. New hires and departures equal out. More than 1, you're growing. Less than 1, you're shrinking. The places that were still growing as of the end of last year: energy startups, hardware startups, medical devices, and biotech. So hard tech, deep tech, whatever you want to call those. They weren't robust growth rates, but they were still growing. The industries that were shrinking were SaaS, fintech, consumer, ad tech, ed tech. It's core SaaS-y standard software startups. Is that going to hold through the rest of this year? I'm not sure, but I thought it was interesting that the industries that were dealing with more real world stuff were still growing, if anemically.
That checks out with VC Twitter about what VC Twitter is saying, which is...
Yeah. I don't know if that's always my favorite, reference point, but yeah, VC Twitter was right.
Yeah, you're the source of the data, right? But the VC Twitter stuff that I'm reading is hard tech is back. That's where investment is going. Versus SaaS software is no longer as sexy as it once was. And the reason why is because the public market multiples have been fucking obliterated.
Bingo. Yeah. I think it's underrated the degree to which those have shifted. I mean, there are whole categories of things that VCs are no longer really interested in. I think the easiest example there is things like DTC retail. If you look at what Allbirds or some of the other startups are now worth on the public markets, there's not going to be a lot of VCs that back that sort of company anymore. Why would you when the public markets aren't believing in them at all? So the changes in public do filter down into private. It may take a little while, but those have real impacts on VC decision making.
It's really interesting for our audience because a lot of the folks that Kelli and I talk to and a lot of our listeners ask us like, hey, what types of companies should I be looking at?
Yeah.
And I think if you're, either a prospective job seeker today or confidentially exploring new opportunities, what Peter just said is what you need to listen to very acutely, which is, hey, like B2B SaaS, direct to consumer, those things are not getting invested in right now. And it doesn't mean that it's all bad businesses, but it does mean that when you look underneath the hood, those companies need to either be profitable or have a path to profitability, because the reality of them getting outside investment is quite low in the new world that we're living in.
I gotta be one caveat there, like B2B SaaS is still a huge category on Carta, and I think it will continue to be a VC backable category for sure.
Yeah.
What's really gone the wayside is like food, apparel, retail, some more e-commerce-y startups. Like those have been far less attractive to investors lately. But to your point about potential job seekers, a lot of the best advice that we give and have seen given to potential job seekers is to approach your next company as though you were an investor. So if you were doing that, what is their path to profitability? What is their path if they're a seed or Series A startup? How many Series B and Series C startups are in that space? Is there capital being devoted to that place? Like you can do some of this research on your own and give, if you're betting on this new startup for your job, you are inherently betting on that equity. And that means you're making an investment decision, just like an advisor would.
It's so important too, because before this macro turned, the last 8 years, money grew on trees. Like no one cared. It was like, yes, I'll take it. Yes, I'll take it. Yes, I'll take it.
Exactly. Yeah.
The level of business acumen jump that I think all these folks need to make now is pretty drastic. And some of these questions you just mentioned, Peter, Nolan, HR people don't even know how to ask them half
I
the
agree.
time. I don't know if there's a place to learn this stuff, but you're so right. And I don't think that candidates or HR people have been approaching these things as an investor for a long time.
It's such a good frame, Peter. I love the frame of a candidate should evaluate a company in the same way an investor would.
Yeah.
I think one of the discrepancies with that model is investors kind of care about the last price, but they're going to come in and set a new price.
Sure.
And so I get a lot of friends who are interviewing at larger pre-IPO tech companies whose valuations were set in 2021 or early 2022 and have not been reset.
Yep.
And like the reality, unless they're growing into it, which very few companies are.
Yeah.
Most companies are, if they are going to survive, are taking down rounds. I mean, even the best companies, like I know Ramp took a down round, like are doing this.
Yep.
And so what's your advice to job seekers that are talking to companies that raised at peak, but haven't reset the valuation?
I mean, this is the sort of catch-22 with today's job market, because I have a lot of advice that I could give to candidates about how you need to approach these conversations, the sort of data that you want from these companies. But I'm cognizant of the fact that in many cases, this is going to be your only offer. And it's difficult to really feel like you have the capacity to push in those conversations when perhaps this is the only job opportunity you have on hand at the moment and you really want a job. Like I want to, so that up front, like caveat, these are tough conversations to have sometimes as a candidate. That said, if a company is only giving you their valuation after the last round of funding and it's been 3 years, heads up. Like
Red
the
flag.
market has completely shifted. It may not be worth that much. The number one thing, and this is less common at the very late stage tech, but if they are giving you just a simple number of shares, that is not enough information. You have no idea how those shares work. You need at the very least, you need the number of shares you get and the total outstanding dilution or share count for the company, so you can have an idea of the percentage ownership. Percentage ownership is the thing that you want. The other thing, Nolan, you and I have gone back and forth on this a little bit. You can talk about vesting schedules. You can talk about post-termination exercise periods. There's a lot of ins and outs with the grants. One thing I'm honestly not sure if a lot of HR folks can answer, but I love candidates who can push on this. The question I always tell candidates to ask is, if or when this company goes public or gets acquired, has an exit of some kind, what is the minimum price per share it needs to achieve for people with common stock to make a profit? What that means is you do not care whether or not the investors make a profit. Oftentimes, investor shares have preference. They're called preferred shares, and they may make a profit to such a degree that the common shares, what the founder and the employees hold, come away with nothing. So
Yes.
just getting an idea of what the company is valued at now doesn't tell you anything about the liquidation preferences in that cap table, all sorts of stuff. So I love that question about what does common stock need to make a profit? Because it gets at the real crux of the argument there.
How much can that vary, Peter? Like,
I mean, it can
the
be
answer to that question.
Look, in a lot of companies, it's not actually that variable. In some companies, it could be a 3x difference. Like it is liquidation preferences, basically for everyone listening, a 1x liquidation preference, which is very common across venture, means, hey, on an exit, the investors get paid back first, whatever they invested. And then the rest of it is shared amongst all shares as common stock. A 2x liquidation preference means the investor gets their money back and then again, once more their money back, and then everybody else shares in it. So if you have an exit for $500 million and your company had $200 million invested and that investor had a 2x liquidation preference, guess what? You're only going to be sharing 100 million out of that 500 with everybody else, not the full 500. So it can be a really big deal.
Oh my God, I just want to stop. I have never asked that. I've asked every question you can think of around equity. I have never asked that question. Did you, Nolan? Did you ask that question at Carta?
So I'll tell you a story. When I was at DoorDash, it was really brutal raising our Series C. And when we raised it, I'll never forget this, is like, Tony came out and, introduced the round. I think it was like 126 million or something like that. And that's how we announced it to the company. TechCrunch then ran a story the next day and said that there was a 3x liquidation preference. And then they described it. I had no idea what this meant at the time. They described it, which is exactly what Peter said, which is investors would make 3x. It basically had to hit a certain price for that liquidation preference to go away. They would make 3x their money before common got paid out. And the way I found that out was a candidate saw the story on TechCrunch and asked me about it. And then I had to go ask Tony about it and what it meant. And look, to put myself in Tony's shoes, most people don't understand this. And so, I think as a founder, you're less likely to just proactively bring this up because it only causes more questions and confusion for people who already don't understand how this works. But this is structure. Like and I think, Peter, the next question I want to ask you is, I've been anecdotally hearing again that more structure is showing up in term sheets. And so what are you seeing? Is there data that backs that up?
100%. Now, I will say structure can mean one of many different terms. It can be higher liquidation preference, cumulative dividends, participating preferred shares. There's a lot of different ins and outs with venture structure. But if we just take liquidation preferences as like a starting point, on Carta, early stage deals, seed and Series A, only about 3% of them have a high liquidation preference. So very few. That's great. And that hasn't really risen too much in later years. So early stage, pretty immune to this. Growth stage, Series B and Series C. 2019, 5% had high liquidation preference. 2023, 9% do. Is that every deal? No, definitely not, but a big jump. Late stage, it went from like 7 or 8% to 17% in 2023. So like,
wow,
these jumps matter. Now, a lot of investors will say, look, if the company IPOs or does pretty well, like a lot of these liquidation preferences will come out in the wash. And that's true, but it still paints the picture of an information asymmetry on behalf of everyone who isn't an employee in this company. So like the overall point is, if you're a founder listening on this call, I get what Nolan said there. Like it's difficult to try to explain a highly complex liquidation preference to every one of your employees at a town hall. Maybe that's not the right venue, but being forthcoming with how investment affects their potential on their equity, I think is really important. And it just is there's less education, there's less focus on it. And in a market like this, it's incredibly crucial to do.
And I will add, it will come at some point, right?
Yes.
Let's just pretend nothing. 3 years later, the company goes IPO. All these people join thinking they're going to make $1 million plus, and then you tell them, oh, just kidding, you're making nothing, or very nominal amounts. I mean, it will come out at some point, unless, of course, nothing happens with the company. But it's just so important. Peter, where can people go? What's the one or two places that you would send people to get smart about this?
I'll speak our own book here for a second. I think that we have some of, if not the best educational content on equity in the world. It's very easy to find. If you go to carta.com/equity, there are courses from celebrities. There are like deep dives with Carta employees about taxes. There's anything and everything. The other offer that I'll make here, which is a new thing that we just got off the ground, which I'm pretty proud of, is if you are a candidate for a startup job, so that's anything from basically Series A onward, you can go to carta.com/friend, give us a little information about the position that you're applying for, and we will give you what we give companies, in salary and equity. We will give you the ranges. So you can walk into that negotiation knowing basically exactly what your recruiter is looking at.
It's just going back to the liquidation preference conversation, and I'm stunned by how big of jumps that is.
Yeah.
And Kelli, you had mentioned like you'd never asked that before. Part of the reason you didn't ask it is because you didn't have to. And now it's showing up, I mean, in almost 20% of late stage companies, like 1 in 5 late stage companies. That is insane.
Mm-hmm.
And so to the point around founders communicating this, or chief people officers or CFOs communicating this, you have a choice, which is one, try and tuck it under the rug and hope people don't see it. But what you're doing there is you're kicking the can down the road. And to Kelli's point, people are going to find out, and it's likely going to be at the worst possible moment that they find out. And then you're going to be behind it, and people are going to be pissed. Versus the other option is you could get out in front of it, communicate about it now, take the tax of helping people understand what it actually means and why you're still bullish, why you took the terms of the deal. And that way people can vote with their feet today. And I think when you say it like that, it seems like an obvious choice, but it does feel easier when you're just talking with people who only understand bespoke VC terms to just like, let's just not bring this up because, you know, if the company is successful, it's not going to matter. That's an easy story to tell when the reality is you're losing trust along the way.
The sting of the timing of that information can be quite severe.
There is some silver lining data that we have showing that founders really do care about their employees. In many cases, employees' ownership and making sure that they're incentivized long term. So a lot of down rounds are happening. That's, you know, when a startup is valued at, say, $1 billion, and then they take the next round, and that next round values them at $700 million, that's a down round. What happens sometimes in those rounds is the actual fair market value, the 409A assigned price of the options for each employee, is actually lower than whatever the employee got when they received the shares. So they're actually underwater on their options. Companies and boards can do what's called a repricing, where they actually retire that old equity and reissue it to those employees at the new lower price so that they have more upside in the equity. And we saw more companies do that over the last year than we've ever seen. Mostly late stage, mostly pretty advanced companies, but it was good. It was heartening to see, like, look, there's no requirement that they reissue this equity, but a lot of companies did take the position, hey, we really care about our employees and we wanted to see that equity repriced. So
yeah,
there are a lot. I don't want to paint all these founders as like bad actors. There's a ton of founders who deeply care about this, but the education piece can get really tricky.
Yeah, for sure. I love that. I was going to ask about that. We were talking with some friends last week, Nolan and I, about this. And I guess a follow-up in addition to that, Peter, is are you seeing companies late stage that have gone from options to RSUs like we did 2 years ago, go back to options? And why would they do that?
Interesting. We haven't seen a return to options from RSUs. Really quickly, the difference between an option and an RSU basically boils down to if you are receiving incentive stock options, which is the majority of startup employees, they are going to have 2 criteria in order to become real stock. One, they need to be vested, and that's usually, 4 years with a 1-year cliff, the standard vesting schedule. And 2, they need to be exercised. So you will need to pay out of pocket some exercise cost to sort of take possession of those options. RSUs basically remove that second option from you. They are automatically exercised when they vest. So that's useful in late stage companies because it locks in a price for the employee, but it can be tough if you have to pay taxes on something that is maybe not going to be worth all that much in the end, and pay the exercise cost.
Or
So
not
there's
currently liquid. It's not liquidated right now. Like you can't access liquidity today with that.
100%. So we don't see a lot of move back to options once you started on the RSU path. But RSUs are also for late stage only. Really, you don't really touch RSUs until you're, I don't know what the marker might be, 700 million, $1 billion in valuation, something like that. So
like
it doesn't really apply to the earliest companies.
Yeah. I was thinking when we were talking about the jumps in the multiple 17% preferences, and I wonder if I follow that bouncing ball, if we'll see talent maybe more at the leadership level choosing earlier stage companies versus the later stage companies, right? I'm just thinking, like, would I choose a Series E with a 3X, or would I choose an early Series B with a 1X? I wonder if that will have a lagging impact on where the best talent is choosing to go in the next 18 months.
That's a really interesting question. I'm not sure we have the data to answer that yet. We do have a lot of information on salary and equity trends for employees, both VP, exec, and above, and then down to the entry level. Generally speaking, hiring, I think for everyone thinking about their next move, like it is true that the executive market, it just functions a bit differently than the rest of the startup market. For one thing, it's more national. So you're not really going to pay that VP of engineering that much less if they're in Boise than San Francisco, the way that you might get a pretty solid cost arbitrage if they're an entry level engineer. So that's one difference. And then two, yeah, the equity functions a bit differently. There are sometimes management carve outs. Like it can get a little tricky.
It's a great question, Kelly. And I think it changes the calculus of risk, right? Because theoretically, as a company gets later stage, they get less risky.
Yeah.
And so the story you tell yourself is, I will have an exit here. Like the opportunity for me to have a true liquidation event is higher. But if there is liquidation preference is involved, the calculus on that changes.
Right.
So I think
Totally.
I think you're onto something. So while we're on the thread of startup compensation, tell us what you're seeing in the data with salary trends.
Yeah, so salary's actually been interesting in that not much has happened, which perhaps doesn't sound interesting at the surface. But if you think about all the macro changes that have happened to startups over the last couple of years, it was a bit surprising to see that salaries are, if you just compare, say, November 2022 to January 2024, salaries are basically flat over that period, maybe like a tiny bit up, not keeping pace with inflation by any means, but also they haven't declined very much. And that's the salary benchmark that we would suggest for the average new employee joining a company. So in that way, I think that's kind of at least a decent signal for candidates. Like the salaries are still pretty strong, but they certainly haven't kept pace with inflation, which many candidates are surprised by.
What about equity?
Yeah, so that's where the bombshell really drops. If you look again, that November 2022 to January 2024, the average equity package granted to a new employee at a startup is down 36%. That's a massive change. And it's wild. And to be clear, this isn't because the company is worthless. That's a separate dynamic. We're talking about literally if I joined in November 22 and Nolan joined in January 2024, and we joined at the same level in the same position at this startup, Nolan would get 36% less equity than I did, which is wild.
Do we know why? Do we know, are shareholders just protecting more? Like
There's a couple of reasons why. This is a little bit of guessing, but educated guessing on our part from Carta. So in the report, we proffered a couple reasons why this might be. So first and foremost, equity option pools for employees typically expand as fundraising happens. So a lot of companies have not had the opportunity to expand those option pools at all because they haven't fundraised in a long time. So they're having to make each individual sliver of that pool last longer. So that's one. Two, this gets into the hiring market. If in 2021 you wanted to hire this engineer and they had 5 offers, you were far more likely to go above your benchmarks for that equity than you were today if that engineer has no other offers. So the top end of the equity benchmark has kind of been eliminated in a lot of these because the competitive or the talent market has just shifted towards employers. So those are two reasons. I'm sure that they're like the general air of be cash conservative, watch your burn also applies to equity. So a lot of that is happening. So it's been a major change.
Yeah, makes total sense.
The most interesting part about that data is that if equity compensation is down from 2022 and you're working at a company that hasn't repriced its valuation, like it's almost doubly down.
Yep.
Because the market valuation is no longer tied to the actual market where it is today.
Yep.
And now you're getting less equity on top of it. So at some point, a new mark is going to come in that's likely lower than where the valuation is today. And your equity's already, you said 36% lower?
Yep.
Damn.
Ugh, I need some more silver linings. We can't end like this.
I don't want to end. I don't want to end this. Okay, one more like bad part of this shitty cake before we get to like frosting on the top of it. So one thing to note here is that employees are no dummies. They have internalized this dynamic, and so when it comes up to that period where you want to exercise your options, employees are saying thanks but no thanks. Only about 34% of options on Carta are exercised before they expire right now. And so why would an option expire?
Wow.
Maybe you were there for 10 years, but more likely it's because you're leaving. So if you think about
Yes.
it, you usually have that 90-day window to exercise. So
Yeah,
really
another shitty cake, that 90-day window, Nolan.
we could talk. I could talk your ear off about how much the post-termination exercise window is bullshit. So if you just think about it, in that 90-day period, only like 3 in 4 basically employees are letting their equity go. They're just saying, thanks, it's not worth the exercise cost. I appreciate being here for 2 or 3 years, but I'm going to walk away with no upside in this company. Which makes, especially if you think about a lot of those people are faced with that decision after they get laid off. So if you get laid off,
Totally.
You're like, I'm going to give this company a little bit more cash to exercise this equity. No way. And so that's another like negative, bearish signal on where people think the value of equity is.
What's not connecting in my head, though, is what you said earlier. The grants are 36% smaller than what they were in 2022.
Yeah.
But what you just said is that people are forfeiting exercising. They're not exercising. And so those grants actually go back into the pool.
They do.
Yes.
Yeah. I mean, I think it's a hidden part of startups that people who don't exercise are a net benefit to the company pool. It's it's like a weird kind of awkward incentive where, back in the day, some founders wouldn't even want their employees to know they had to exercise in 90 days because they were like, hey, if it returns to the pool, more to the benefit of me and handing that equity out again to the next employee.
Yes.
But
Yes.
in general, I think the overriding dynamic here is that it really gets back to the hiring numbers. Like the talent market competitiveness dictates how lenient or generous a lot of these employment structures are. So if you could hire one of 5 great candidates and they all are looking for this job and they're willing all to take it, like you're just not going to need to compete the same way you would if they all had 4 other job offers.
Makes total sense. Peter Walker, I promise next time we'll end on a higher note.
I was actually racking my brains. I'm like, what is a good sign that we can talk about here?
This is the reality.
We'll wait for one, and when there's a good sign, we'll have you back on.
Oh, so I was just going to say, Peter, we have to have you back when you guys put out the next report. Sure. Because this level of breakdown gets to a level of granularity that everyone wants to better understand and informs people on how they make career choices. Yeah. So we can't thank you enough for the time. We are absolutely going to drag you back on the show in the next couple of months. 100%. And thank you so much.
Yeah. Thank you, Peter.
I'll come kicking and screaming. No problem, guys.
All right. HR Heretics is a podcast from Turpentine, the network behind Econ 102, Moment of Zen, and Turpentine VC. Subscribe, 5 stars, share it on Apple, YouTube, Spotify, anywhere you get your podcasts, all the things.